Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week at Everything You Need to Know in 90 seconds at 9 o'clock with news the world trade landscape is changing, with imports falling worldwide. It does look like the end of the beginning in the US-China trade war has arrived. The so-called Phase 1 deal has been agreed, and the US won't impose the next set of tariffs. Neither will China. And unlike other claims, this one has been confirmed by Beijing. Market reactions are mixed. American equity and bond markets weren't enthusiastic, but the Shanghai equity market rose an impressive 1.8%. Tokyo rose even more, up 2.6%, and Hong Kong was also up 2.6%. It will be interesting to watch Wall Street when it opens tomorrow. The deal sees the US halve tariffs on about $120 billion of trade, while the Chinese don't have to reduce any tariffs, but they said they will. China will buy some ag products, but actually how much is in doubt. The key element is that this ambition is very low, with enforcement a joke. So the deal is more theatrics than groundbreaking, and the international community won't be following this model. This is a time, however, when we can assess the impact so far of the trade war, not only on the US and China, but other large economies as well. Import volume data compiled by interest.co.nz shows that imports fell at the least in the US and only recently. From its peak in June 2019, American imports have fallen just 0.5% of GDP since. That compares with 0.8% of GDP fall in Japan, a 0.9% GDP fall in the EU, and a 1.4% fall in China. So it has been China, not the US, has used this time to wean itself off imports, and most of those are from the US. Basically, the Americans have kept on buying Chinese goods, and the American public or businesses have paid the higher tariffed prices. So perhaps there's no surprise that Washington has wanted a deal, one that seems to have damaged their trade, but their superpower rival very little. The Phase 1 trade deal won't move either China's or the US trade, even 0.1% of GDP either way. Maybe there's another reason for the muted Wall Street response. Weak November retail sales. They rose only at a very modest pace in November, virtually flat from October, and up only 2.9% above the same month a year ago, and a slower than expected start to the holiday shopping season. And given that American inflation is up 2.1% in the year, the gains look very mediocre. In China, foreign direct investment levels are rising. They're up 6% in 2019 so far, a gain of $124 billion. Almost 30% of that is in the high-tech sectors, and that portion grew a remarkable 28% in the year. And the IMF is warning Australian regulators to be ready to act should rapid housing debt growth continue on current trends. They say looser financial conditions could reaccelerate asset price inflation, boosting private consumption and also adding to medium-term vulnerabilities given high household debt levels. US Treasury 10-year yield is at 1.82% and very little different from this time last week. Gold is at $1,476 an ounce and up $16 for the week. US oil prices are up further to just on $60 a barrel, and the Brent benchmark is now just on $65 a barrel. And the Kiwi dollar will start the week firm at 66 US cents. On the cross rates, we're holding at 95.9 Australian cents against the euro with little changed at 59.3 euro cents. That puts our trade-weighted index just on 71 and marginally firmer for the week. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.